Things are going pretty well. I've bought my raw materials, I've stored them in the factory, I've sold them, my receivables have turned to cash. So I'm sitting on a lump of cash, but what am I going to do with it? Maybe the cash is offshore. Maybe if I bring it back to my domestic currency or country, I would be subject to some tax bills. And this is what we saw for many years with companies like Apple, for example, with billions, tens of billions of cash offshore waiting to be repatriated. Now, of course, the movement of those foreign currencies offshore will have an impact on the size of balance sheet of the company. But what it also allows the bank to do is to offer you structured deposits. For example, if you have payables in another currency, what we could do is this. We can give you what's called a dual currency deposit. Now, the way it works is this. Imagine if you gave me €1,000,000. On the €1,000,000, I'll pay you probably 0% if you're lucky, if it's your birthday. But then you come along to me the next day and I say, do you know what? I'll pay you 3%. How come? How so generous? Well, this is what we're going to do. You give me €1,000,000 and in 3 months' time, I am going to have a choice. I can either give you back your €3,000,000, in which case, well done, you've earned 3%, or I will give you back $1.12 million. There'll be one amount or the other, €1,000,000 or $1.12 million. Well, why would I want to give you back dollars instead of euros? What the bank will do is it'll always give you back the weaker currency. Because if the dollar weakens, what I will do is either bank will keep the euros and put the dollars to you, which means you end up with $1.2 million, $1.12 million, which is now only worth 950,000 euros. And you think, oh great, why did I do this? I started out the morning with €1,000,000. I've now ended up with dollars which are worth 950,000. What was I thinking? Well, yeah, it's not good for your deposit, but imagine this. Imagine you're European and you had bought a flat in New York with a dollar mortgage. If the dollar depreciates, it's not very good for your dual currency deposit, but the good news is with the mortgage, you're spending fewer euros to buy the dollars to pay off the mortgage. So you have a natural hedge. So what banks will do is they will look at where you have payables or debts or money you owe in a second currency, in this case dollars, and they will say, well look, let's do a dual currency deposit. You have a natural hedge. So just food for thought. So rather than having no balances on your cash deposits, you can make use of currency exposure, but be aware. In this case, principal is at risk. If you don't want to do that, do a structure where your principal is protected. Now you'll get a lower coupon, but you know the worst thing that can happen to you.